GetCrack. Wake up, motherfucker.
Now, Lorenzo Simonelli, the CEO and chairman of Baker Hughes, fresh off of Q4 earnings that were much better than expected. Lorenzo, it's great to speak with you today. Thank you for taking the time.
Good to see you, Morgan.
So let's start right there with fourth quarter earnings and how that sets you up for 2025, especially since, once again, the star of the show was really this industrial and energy technology segment, the IET segment, which makes things like products and machinery and technology for natural gas.
Yes, first of all, very pleased with overall performance in 2024 for Baker Hughes, and across both of our segments, continuing to see the margin accretion that we've stated before, and also the activity levels. And as you look at industrial and energy technology, another record-setting margin performance. And also, as we look at the last 3 years, we've been able to bring in over $40 billion of orders, and last year marking another $13 billion of orders. And we're really seeing tailwind in the activity of compression, liquefaction, where we produce compressors, gas turbines, we've got pumps, we've got valves. And this is going to continue as a theme as we go into 25 and also 26, as we also start to see the US LNG FID start to come back. And over the course of the next 2 years, we see over 100 MTPA of FIDs that are going to be taking place.
What is propelling that demand?
It's the thirst for energy. And as you look at the consumption globally, and also the opportunity to take natural gas, liquefy it to Southeast Asia, to Europe, when you think of also the increased demand from generative AI and the requirement from data center perspective, overall, as you look at the predictions, there's going to be an increase in energy demand of 10% over the course of the next decade. So that is something that, as population continues to increase, we continue to consume more energy.
And of course, AI, we know this has been a conversation as well, the thirst for power tied to AI, particularly in this country, in the US too. So when you think about infrastructure and this demand, how much of that is domestic, how much of that is international moving forward, especially as the US does look to now export more LNG to places like Europe?
I think we've got a lot of opportunity because of the abundance of natural gas within the United States. And again, it's affordable, secure, and also from an emissions perspective, lower than coal. So we see a lot of opportunities from a US perspective of continuing to export LNG. And as you look at the projects that are undergoing, as well as new opportunities, you could have as much as 250 MTPA from the United States being exported and provided.
And on the oilfield services side, what are you seeing? And we've heard from both the CEOs of ExxonMobil and Chevron here on CNBC just earlier today. And what they've talked about is the fact that they can continue to maintain and even grow production, but do so without spending more money because the process of producing and extracting that oil is getting more and more efficient. What does that mean for Baker Hughes?
Well, it fits right into our strategy and being able to do more with less. And it's the mature asset solutions. When you look at Baker Hughes and our oilfield services and equipment segment, over 50% is related to the production side. When you look at electrical submersible pumps, you
Mic on.
Oh, hold up. Man, this thing. I gotta freaking reload this thing. Oh boy, hold up. Man, I got no clue about this. Come on.
Now, Lorenzo Simonelli, the CEO and chairman. How much of that is domestic? How much of
United States. And again, it's affordable, secure, and also from an emissions perspective, lower than coal. So we see a lot of opportunities from a U.S. perspective of continuing to export LNG. And as you look at the projects that are undergoing, as well as new opportunities, you could have as much as 250 MTPA from the United States being exported and provided.
And on the oilfield services side, what are you seeing? And we've heard from both the CEOs of ExxonMobil and Chevron here on CNBC just earlier today. And what they've talked about is the fact that they can continue to maintain and even grow production, but do so without spending more money because the process of producing and extracting that oil is getting more and more efficient. What does that mean for Baker Hughes?
Well, it fits right into our strategy and being able to do more with less, and it's the mature asset solutions. When you look at Baker Hughes and our oilfield services and equipment segment, over 50% is related to the production side. When you look at electrical submersible pumps, you look at chemicals, and there is a theme that we've been calling out for the last few years that's continuing, which is utilizing the assets and getting more recovery from the assets. So it really fits into the mature asset solutions that we offer at Baker Hughes. And we've seen a more stable and growing opportunity for us in that section.
What does that mean in terms of the services you can offer and the role something like AI would play in it?
So AI will be able to, again, efficiently drive productivity and also help recovery. So we apply, when we're going through directional drilling, the aspect of precise drilling. So you go to the spot with the largest recovery. When you look at our products that we provide, it's again uptime from an electrical submersible pump and being able to use the data analytics and also the algorithms and generative AI to make sure that you're predicting, anticipating, so you don't have the downtime. So across our portfolio, we actually have a number of AI, generative AI analytical tools that we provide to our customers as software.
We've seen a flurry of executive orders come out of the Trump administration since January 20th. We already touched on it a little bit with LNG, but we know that this is an administration that wants to see drill, baby, drill. Do you expect that to happen? How are you planning for the possibility of more production coming online, if in fact it is going to come online here in the U.S.?
We do see slight production increase in the United States, and I think the administration theme around energy security is one that fits again well from a Baker Hughes standpoint, and our sustaining of the production that's in place and assisting if there's incremental production that's going to be happening. I think the E&Ps will remain, again, disciplined with their capital deployment, and it's all going to be a function of what happens from an oil market perspective and the pricing.
In terms of crude pricing, is there a level that you watch closely where you say it starts to fall to here and we know that production is going to start to come off?
There's different theories. I think right now we're range bound, and if you look at the 65 to 80, people seem comfortable with that range. Again, I think it's probably a better question for some of the E&P companies. We are focused definitely on helping them be as productive as possible.
And finally, there's a lot of focus on trade policy. Looks like tariffs are going to go into place on both Mexico and Canada this weekend. Unclear yet whether that's going to include crude oil. What would that mean for the energy market, and how do you plan for something like that?
Again, we've looked at this before, and it's not new that tariffs have been talked about. We've got a supply chain that is very versatile, and we simulate different things. And so we look at it as being immaterial from a Baker Hughes perspective, and we will navigate the course accordingly.
Lorenzo Simonelli, CEO of Baker Hughes, thank you so much for joining me. Appreciate it.
Thank you.
Mega cap tech trying to weather this tariff storm. Meta, Alphabet, Microsoft, all outperforming the Nas as AI remains a key part of the narrative, especially with major new development from OpenAI this weekend that could reshape the whole race. Our Deirdre Bosa has the state of play in today's Tech Check. Morning, Dee.
Hey, good morning, Kyle. So a new dynamic very much on display over the weekend in Sam Altman's Reddit Ask Me Anything, also known as an AMA. Now, in response to a question on whether OpenAI would release model weights and publish research, Altman replied, "I personally think we've been on the wrong side of history here and need to figure out a different open source strategy." And this is just a remarkable statement from a leader who has long championed the closed source approach, citing safety, competitive dynamics, monetization as key justifications. For Altman to now admit that OpenAI may have been on the wrong side of history, that suggests mounting pressure and could have ripple effects across the AI landscape. For one, it validates Meta's strategy and puts pressure on other closed source players like Anthropic and Google DeepMind to clarify their own positions. During that AMA, Altman also admitted that DeepSeek R1 is a very good model and OpenAI will produce better models, but will, quote, maintain less of a lead than we did in previous years. Another extremely telling statement that signals OpenAI is no longer operating from a position of clear dominance, as open source models and a process called distillation really close that gap. And indeed, since DeepSeek's breakthrough over the past month or so, the entire space is moving faster than we have seen it move in a very long time. There's this test called Humanity's Last Exam. It's meant to measure how close AI is to true human-level intelligence. In less than 2 weeks, guys, the top-performing model more than tripled its score, and 5 models now outperform what was recently the best result. All of this to say the competitive landscape is exploding, and investors may need to reassess their time horizons for advancements. Faster model progression, that could lead to more volatility in valuations. Expectations around moats and market dominance, they are shifting by the day. It also creates new and quicker opportunities, particularly in the application layer, where companies can build on these evolving AI capabilities. We saw that this weekend with OpenAI's launch of a new deep research tool, which scans the internet and gives users a comprehensive, concise report. Guys, the last thing I want to leave you with is this chart. Speaking of Meta and open source validated, look at Meta. Its shares have outperformed Google, Microsoft, Amazon since last Monday when DeepSeek changed the race. I know there's earnings in this too, but I mean, it all comes down to where they are in AI.
For more on the fallout, though, regarding these headlines, let's turn to our senior economics reporter, Steve Leisman, who's also got some flash Fed surveys. Hey, Steve.
Yeah, I just got the phone with the White House, Carl, and I can confirm the White House is confirming that the Mexican tariffs will be delayed by 1 month. Did not get much opportunity to talk with the official, but the official did confirm, CNBC can confirm that the Mexican tariffs will be delayed by 1 month. So what the Mexican President Sheinbaum said is accurate about this 1 month delay. Let me just turn real quick, Carl. Do you want to talk about that, or should I move on and talk about what the survey says about the economic impact of all this?
Surveys, Steve, for sure.
So it is hard, Carl, as you may know, to get economists to agree on anything, but they're united in believing that tariffs on China, Mexico, and Canada will reduce U.S. growth and boost inflation, though they disagree on how much. Every one of the 20 forecasters we surveyed in a flash CNBC Fed survey over the weekend predicting lower GDP in 2025 with an average of minus 0.6%. All but 2 forecasting higher inflation in 2025. Prices expected to rise by an average half point above what they otherwise would have been. The range of impacts, though, does go from minus 0.1, in other words, a pittance, to a very substantial minus 2%. For the CPI, the range is, as I said, a couple guys came in at 0. And the upper end is 1.5%. John Donaldson from Haverford writing in with the survey. To my knowledge, there has never been a happy outcome from a trade war. Alan Sinai says we have entered dangerous, uncharted territory here. Key to the impact is how long these tariffs may last or when they take effect. With the most believing they'll be short term, you can see most people think they'll be lower than 6 months or only last about 6 months. After that, a few say, a large chunk say they don't know. CNBC asked the White House if there had been an economic analysis of these tariff impacts, and they responded that the focus was on fentanyl deaths, which don't have a price. They sent a background sheet with no numbers, but it said in part, quote, tariffs strengthen the American economy, raise wages, and create jobs. They bring back manufacturing to the U.S. and reduce trade deficits. Kevin Hassett, the president's top economic advisor, saying on Squawk Box this morning that this is a drug war, not a trade war. He added that he's preparing economic analyses that take into account all of the president's proposals, not just tariffs, and that he expects they will show a positive growth impact. We'll be talking about some of this stuff with Susan Collins, Boston Fed president, at the top of the hour. Guys?
I think that'll be important, Steve, because the question is, how does the Fed deal? So now, I don't know what you think, but it looks like this is a sort of one-off. It's not a gradual increase in tariffs, or at least at the moment. And so that should lead to some sticker shock for Americans, but it would be hard for the Fed to respond to that if it's coming from tariffs and not demand side inflation. I think the bigger risk is that the unemployment rate rises and all the uncertainty and potentially new business decisions, and they would have to respond to that.
I think you just laid out a great case, Sarah, and I think you agree with me that the Fed needed to pause in January and maybe pause again in March. Here we are on the eve of what we thought were going to be tariffs on Canada, Mexico, and China, and now we don't have the Mexican tariffs. So they're going to be delayed at least a month. You saw the range of forecasts out there from 0 to 1.5 when it comes to GDP or to CPI, and then from minus 0.1 to minus 2 when it comes to CPI. So these are very, very difficult things for the Fed to come in. They cannot play politics, but they also can't. They have to forecast the politics of all this, which are very difficult. I think you're right. There's an unemployment aspect to this. And by the way, there's also a recessionary aspect to this. One of the reports I read over the weekend, Sarah, said that a Mexican, with the tariffs, a Mexican recession is now the base case. So you have to think about that as well.
Yeah. Steve, thank you.
Given that I know so many people are waking up this morning and they're turning on their TV and they're thinking about tariffs and trying to understand what's happening. As I said, there's a market sell-off literally happening as we're speaking. And so I want to get there with you just to understand what's going on, even inside your own firm, as you're thinking about it this morning.
Well, there's so many moving parts and there's so many things that are cross currents. The one thing that I would say is this is a completely, totally different landscape than Trump 1.0. So if I go back to January of 2017 and I look at where we were in the three big asset classes and where we are today, wow. It's a much, much shakier ground that we're treading on. For instance, let's take fixed income. In 2017, we were asking the investing public to pick up $1.2 trillion worth of duration. That was how much we were issuing at the Treasury. This year, that number's $2.7 trillion of duration. So that's just, it's an all-time record. So that's a completely different landscape in terms of the bond market. If I go to the foreign exchange market, in 2017, there was $8 trillion that foreigners had invested in the United States, more net $8 trillion that they owned more of us than we owned of them. That was 40% of GDP. Fast forward to today, that number's $23 trillion. Foreigners own $23 trillion more of U.S. equities and debt and real estate today versus 8 in 2017. That's 80% of GDP, twice what it was. And again, it's a good problem because it shows that American exceptionalism has drawn that capital in. But we have to be careful. And then finally, if I look at the stock market, January of 2017, kind of average PEs were around 19. Today, they're 25. We're a full 30% higher than we were in 2019. We could have a 30% correction in the stock market and just be back to slightly overvalued. So Trump 2.0, I think Trump being Trump, I don't know if it will play as well as it did in 1.0 because there's no room for mistakes. And look, he's my president now. I pray he makes all the right decisions because we are precariously perched from a macro standpoint. I don't think we've ever had as many things that are connected and circular and could go wrong. So it's going to take a maestro to pull this off in a way that kind of preserves where we are now in the major economic major asset classes.
Box this morning, Just Capital out with its list of America's most just companies. CNBC is Just Capital's media partner. Joining us right now in an exclusive interview, legendary investor Paul Tudor Jones, co-founder and chairman of Just Capital. He created all of this. He's also the founder and chief investment officer of Tudor Investments, of course. Also Antonio Neri. He's the CEO of Hewlett-Packard Enterprise. It is ranked #1 in the Just 100 for the second year in a row. And I've got about 1 million questions for all of you, including tariffs, given the news of the moment right here, Paul. But I want to start with this list, and I want to start with actually just a very 30,000-foot question, which is, it feels like the world has shifted, even in the past couple of months, politically and otherwise, around so many of the issues. This whole idea of almost stakeholder capitalism, ESG, DEI, all of that seems to have been thrown out. Maybe the baby's been thrown out with the bathwater. I don't know. But I'm so curious, given that your work is based on polling, based on what the American public actually wants, and you also just had an election, and how you think about all of this.
Well, first, let me just say it's ironic that we're here on the day to celebrate the best of American business on the same day that we're also tariffing the hell out of them. But it is what it is. And what I would say is that the election result that we saw and President Trump taking office again, I think is completely congruent with the polling that we saw this year for what constitutes just behavior. The #1 issue, and it is year after year after year, is pays a fair and living wage. It's all about the American worker. And President Trump was elected to office because this country felt like the middle America, those that sit there and work for all these companies weren't getting a fair shake. So I think this is exactly synchronous with what we see in our polling. And it's so funny when you mention DEI, ESG, all those terms. I can tell you at a macro level, just polling that we do is about USA. And I know it sounds corny, but it's a fact. It's about what the American public thinks is the best behavior for corporations to do on behalf of all Americans and all stakeholders. And that's workers and communities and customers and shareholders and the planet. So I think, if anything, if you're a MAGA person, then you got to 100% respect what our polling shows, because all we're doing is asking the American public what they think. It's as MAGA as there is anything.
Before we get to Antonio, let me just ask you this about performance, because one of the questions is how correlated the outcome of the Just 100 list is to performance and, maybe importantly, outperformance. How has it changed over the years? Yeah,
so since our inception about 7 years ago, the Just 500 has outperformed the Russell by about 10%. The Just 100 has outperformed the Russell by about 40%. The Just 100 has outperformed the S&P by just a little bit. But the point is aligning yourselves with what the American public thinks is great for business is also great for your shareholders and your share prices and your business in general. And there's nobody that embodies that better than that gentleman, Antonio Neri, who he really is the classic American dream story. He started as an intern at Hewlett-Packard Enterprises and worked his way to CEO. There's no better Horatio Alger story than him. And trust me, we would all want our kids to work at HPE, given the things that he's done.
Well, that's what I was going to ask. Thank you for that, Paul. Antonio, it's nice to see you this morning. You've now been at the top of this list 2 years in a row. And I'm curious what you think you're doing differently than other companies. And frankly, how much you think about the various metrics with which you have succeeded on this list. And by the way, I should say your stock did outperform in a very big way this past year. On a longer-term basis, it's a little bit more of a complicated story. But when you look at these metrics with which you've come atop this list, how much are you focused on those things individually, or are you focused on something else, and it just so happens that you've come out on top on the other metrics as well?
Yeah, well, good morning, Andrew, and good morning, Paul. Nice to see you again, and thank you for the amazing honor and recognition for the second year in a row. It's an honor that we take very seriously, and our 60,000 employees are cheering today for, again, this amazing award that we take very, very seriously. To your point, Andrew, you know, when I became CEO, believe it or not, 7 years ago, 2 days ago, you know, one of the key priorities I had was culture. Culture is everything in my mind, in addition to focus to our customers and our innovation. And out of the culture, the center are our employees. So how we create an environment where everybody can come to work and thrive to create business value that ultimately is good for shareholders and for the communities we operate. And there we put a lot of emphasis on about our values, our benefits, and our ability to attract, retain, and develop that talent and pay equally. And so I'm very proud of the work we as an organization have done for the past 7 years. And we see that in our results. It's not just the Voice of the Workforce survey that we do every year, where this company now performs consistently in the mid-80s, with our lowest attrition rate they ever had, including the top attrition rate, which is very low single digits. But it's the ability to really attract that talent, that continue to fuel that innovation, to solve some of these biggest societal challenges we all face, you know, ensure that these technologies like AI are inclusive, that ultimately, you know, we design systems that consume less energy, and then think about the circular economy that we drive. But in the end, it's all about those employees that come to work every day.
All right. Welcome back. Tonight, I'm going to do something quick for you guys. I played some of those videos. Let's go look at the markets right now. And, well, it's not the 4th yet. It's still February the 2nd, or the 3rd, I mean. My bad, the 3rd. So let's look at Hong Kong right now. Shrugging off the trade war. Doing pretty well. So you see this gray line I've been drawing. It's following that. So it should break out by May. So let's see what the Hang Seng will do for then. And we're in this box here. If you look at this chart, we're still in this box. Very good. We're bouncing off support, going back to this resistance area. And once we break out of 22,000 to 23,000, we can break out again. So that's about May. Okay. So we're going to look for Chinese stocks. I'm going to play a little video on China. I think Samantha LeDuc is also quite bullish on China. So I think, yes, this is where some of the opportunity will be at. Okay.
Introducing the 3-part options.
Skip ahead here.
Position in his portfolio, and he knows everything about it fundamentally and technically, and he knows the backdrop of the China macro better than most. So long story short, yes, they open on the 5th.
Yeah, and so that's an interesting play. So I had BABA, I had some downside, I had risk reversals on to basically try to finance some upside. Didn't work out a few months ago and reversed down. And so we got into the 80s through some of my strikes. I had an 88 strike, a 92 strike. And I thought, well, okay, this is a very, very cheap stock. It's got a lot going for it. It's in China. So you never know if the market will eventually kind of latch onto it again. And of course, it just needed an excuse. And it got going. But I remember we were sort of looking at, this is what kind of a good lesson in covered calls, because a lot of probably some of the people watching, some of the folks watching trade covered calls, and it's part of the challenge sometimes is really knowing when to cover and then when to not sell calls anymore. And so one of the things that I always like to say is,
all right, so we're gonna skip this part. We're gonna jump up to 15 here. If you want, you can go to the description and watch that video.
There was a yuan devaluation. It was a back here at the bottom.
Short calls. Now we can't always get it perfect in my upside. So, that's a good thing for folks to remember. Just always kind of look at it as risk reward. What is my risk? Well, my risk is that you have 2 risks, right? You have downside risk, of course, which I'm assuming you're mitigating by owning something decent, at least selling options on something decent, which is also why I always tell people, make sure you like what you're trading against. And then to the upside, you need to mitigate that upside by not being short calls. Now we can't always get it perfectly. This is going to happen. Sometimes you're going to get run over, and that's just life.
And this is why I'm bringing up the monthly chart of the Shanghai, because you're talking about BABA, which is something I have followed extremely closely and recommended at the IPO low last January. So as a trend trade, this is choppy. As a swing trade, there are key times to come in and grab it, but on a trend, but sorry, not on trend time, I meant on a chase like we've had of the past week, right? Where it started to percolate on Friday and then followed through like hot fire flames for a whole solid 5 days. This is different. This is the trend time frame. So the trend time frame is on a monthly. This is the Shanghai. Now, right now the market is closed, but when we open next week, this is going to be very, very likely above. I'm going to zoom out a little bit because I think that might be a little confusing. Back here at the bottom, in 2006, before our market, forget our market, this actually broke out. I call it the wall, where you can just see a trend line break, and it got extremely parabolic. This happened again, so we got in purple, and that was absolutely a shorts nightmare. Okay, then we had it again. There was a yuan devaluation. It was a very, very volatility producing event here in the US because Forex, believe me, if we get rate volatility, it will absolutely spill into equity volatility. And that's what happened because it was unannounced. So at that time with that yuan deval, we also had another breakout. See that? And shorts were crushed. And like your covered call situation, that's stay away, because this is not a time where it's flat. This is a time where it's explosive. And we had an itty bitty little event here in, I would call this very small, but choppy, where at least it got above and then it kind of trickled down and finally moved, but not very excitedly. Anyway, long story short, we are here. So this trend line on a monthly, which right now you cannot see, if I had a crayon, you would see where there's a little bit of a.
Are we just popping up a little bit?
Can you see? I want to see if I can, I don't know how to zoom this out, honestly, but it doesn't matter. But this is not popping out. But when we open next week, it will, because this is a monthly chart and the market in Shanghai has been closed for a week. So the point is, we have to see if this is going to be explosive. In other words, I'm not talking about US investors here. I'm talking about over in Shanghai, this momentum, this gambling mindset that can take hold, especially if there is cutting tech, which it is in the DeepSeek and probably some others. And if they were to get not stimulus per se, because I'm actually not really believing they would, but further yuan deval, there are reasons both from the FX perspective, the macro, yields, dollar, same thing that we have over here. Well, over there, it's their yuan and their yield curve that is very much right now feeding this move if we can get and stay above. So that would be, for me, the only cautionary tale. You might be in another situation, might not, it might get rejected. It's not believed, but for right now, this is definitely your risk area of it moving and getting very, what do you call it, excited. So that's one of the reasons why I zoom out and I look big picture. But
where's that recent move, Samantha, on there? Where is that recent move that we had, the sort of big head fake we had a few months ago?
Oh, I can show you that on a smaller time frame. A weekly is much better than the monthly. Hold on.
Okay.
So how are you going to?
But that's important, right? We're actually,
Right,
if we break through there, that's something that we actually didn't get a few months ago. So this is something that could be a little bit durable, possibly.
So I was very, very negative. But in October, lucky or good, I watched this BABA like mad. Everybody, all clients know, fly on paper. So this, when I actually saw this moving higher in October, and then when it hit the wall, just kind of showed you, I literally did a post. It's hitting the wall. The only way it's going to get above is with stimulus, and it's not time for stimulus. And then we had another kind of knee-jerk reaction in December, which was short-lived. It was only a week or not even a week and a few days. And I said, again, it's too early. We've got to get Trump. If he's going to negotiate anything, he's got to, first of all, get through the inauguration. We still have to deal with all the macro backdrop of China. It's not time. I would say the earliest, and I kept writing this and saying this, the earliest is March. So for this really to get above the wall, they've pulled that forward. In my humble opinion, they've pulled it forward hard. But you're looking at a weekly, let me just show you our screen two. There we go. So this was December, very, very large, ginormous parabolic run. And then it came back down. That also, by the way, happened to be weekly resistance. I didn't put that red line there. It just happened to be there. So this is the difference between the monthly, where I was showing you big picture back to 2000. And this is just the most recent spike that we had in October. And then most recently in December, we had another little push, but nothing exciting. It's not there yet. That's why I've cautioned, if you're chasing BABA, great, but just kind of keep in mind that we really need to get over the wall. And for right now, we can't really see any price action because their market has been closed for over a week.
Yeah, I mean, I've been selling into some fairly nice premium. So again, just like we were talking about a moment ago, don't just sell calls because something's going up, right? So I read a great quote earlier today. It was from a floor trader from years and years ago. Literally, I read it 40 minutes ago, and it talked about how you really become a great trader once you learn the ability to add to a good position. And so in this case, I'm saying you don't necessarily have to add to a position, but don't get in the way of something doing well. If you don't have any kind of edge from a trend line, maybe a monthly. I love how you look at things from all these different perspectives.
2 hour to 1 month.
It really, yeah. I mean, it can all make sense, right? It's always important to kind of zoom in and out, forest for the trees kind of stuff. And so I love that, because you can really get caught in the noise in the moment especially when you trade markets actively. You can really, really lose yourself in the minutia of what's going on and forget about sort of the bigger picture. And so, with covered calls, you want to just make sure that you're getting edge from somewhere. It's either in volatility, it's either on the technicals, it's either in news. It could be as simple as whatever. There's a big lineup around the block for the new iPhone, whatever it's all edge, whatever it is, but have some edge. Do not just sell calls into a rising market, especially if volatility is getting crushed and you're getting less and less sort of compelling reason to do so. So, let it go. Let the move happen. Let it tell you when it's starting to top out. You're not going to pick the top. Very few people are that good, but you're going to look for some sort of indication that a top is forming or that a consolidation is happening, and some sort of, kind of pattern that leads you to believe that things are kind of, sort of calming down a little bit. And then that's where you can start to pick away at those spots. So I like that. Just, so I've been starting to sell. I sold some 100s, I sold some 110s, and that's it for now, but we'll see what happens. So I think it's just kind of an interesting market, because I think NVIDIA, I've had a lot of people ask me about NVIDIA over the last few days, and they have positions. And I said, well, it's not that, and I know
All right, so let's look back at China right here. So this is the Wyckoff thing I drew way back when, right? You see that? Look at the Wyckoff chart. Okay, now let me zoom back here. So we did all that. And October, we had a pump, and it fell back, and now I'm waiting for it to come back up here. Come back up to 22,500 on the Hang Seng for China. So yeah, we got the Alibaba stuff from the DeepSeek. We might have some more later on. I'm thinking China's got a thing going. And Samantha's on board with it too. So can't really fight the trend right now. Okay, let's continue
about it. And Gerstner came out and he was talking his book because he's long NVIDIA, and he says, nothing's changed. It's quite possible that nothing's changed from the perspective of valuation for the near term, or for maybe over the next year. I agree with that. It's not an extremely expensive stock, but you have to think of where we've come from. We've come from 2 years of just it being the poster child for AI and for everything it represents, and it's gone up however many times, 5 times. And so we have to always remember that market performance comes from the margin. And so if that marginal difference in narrative has worked into this story, it is no longer the same story. So I'm just telling people, look, I'm not getting super bearish. I do think it can head to the low 100s, but I'm not committing a lot of capital.
We were there on August 5th. Remember
why not? I mean, this is not the same story anymore that it was potentially.
This is actually much bigger. This is actually much.
So I'm gonna zoom to the next topic with treasuries. Okay, let's go here.
Traded historically, then you feel a little bit better about that. So sold those today, and then this was the other play. We kind of came in, and I've been wanting to get involved in Meta, and so it kind of broke out here. And then Monday happened, and we literally, I think pre-market we were under 620, so it actually looked a bit uglier. Down like $15, and I said, Hans, you didn't listen to yourself. You put your alert in. That was your signal to get out of a position. You got busy doing something else. It happens, and that's where you should have acted on it. So I love those. And now on a day like Monday, it's like a symphony of alerts going off. So you of course, it's overwhelming because you have all kinds of things happening, but go through them, take a look. You put those alerts on there for a reason, and they warrant definitely taking a closer look. So that's simple stuff, right? That's not option trading.
No, but
That's just,
it's a good
hey,
reminder.
yeah.
Also a reminder that the Scott Bessent, a question by Alejandro, is that yes, he will have to determine after tax receipts and all that kind of stuff, the composition of short duration, longer duration financing of the fiscal deficit. But I don't think it's going to be so easy. We've talked about this already a lot, that dollar and yields kind of make the weather. And right now they have successfully, quote unquote, talked down the dollar and yields, but now they're going to have to put in place policies to follow through with that, not too fast. So this is all part of their industrial renaissance move, and it's going to be just damn hard. I think they're going to have a really, really hard time. And that's also part of the fuel of doing short duration, right, that Yellen did, which was adding liquidity, which is why we had such an outsized move since November.
All right. Yes, this is important. We got Scott Bessent as Treasury.
November 1st of 2023, Fed paused, and the Yellen Yahtzee, what I affectionately refer to is that liquidity pump, because she did short duration. Bessent has been very vocal about that being a bad policy. So if he does, there are other mechanisms and other levers, and we're out of time already. But the point is, I don't think it might be a mix. It might be more of a mix. And that's going to kind of also create some of that chop that we've got in the market versus a directional bullish bent where Yellen would have goosed the market, but her guy didn't win. So, and she's not here anymore. And I don't think Bessent wants to go whole hog tariffs, although, by the way, 2.5% a month is not moderate. It's very harsh. That's my opinion. And I don't think he's going to go whole hog longer duration, because that would also be very harsh. So for right now, I can't answer that because we've never seen this guy perform on a treasury basis. We've only seen his returns as it relates to a very easy economy, by the way, with a Fed that was constantly pumping and QE constantly dripping into our veins so that hedge fund managers could make a lot of money. So now he's got a whole different job. His job is supposedly to get the industrial renaissance going again. And that's a very different portfolio to manage. So right now I have no idea what he's going to do, long story short, but I don't think it's going to be a Yellen approach. It might have a little peppering in there, but we'll have to wait and see. Honestly, it's not expected. Not like BOJ or Fed. That was much easier.
My final point I wanted to make was I've got a hood position, which, as you know, I've just loved. So I've been financing an upside call spread with some short puts. And what I did was, this was a couple dollars ago. I should have waited, but I had.
All right, so you got that. I think, yeah, Bessent's going to be a wild card. And we got Elon in the Treasury Department. These things are not going to be easy to figure out how this is going to play. So let me just go over some of the articles I did this morning. Again, let's go over them. Let's see if I can get through them in a more comprehensive way. Oh, by the way, Palantir, after hours, earnings 22%. And it looks like it's holding overnight. So it's above 100. I'm probably going to sell a bunch here tomorrow. See if it stays over 100. I'll sell a chunk, and then probably in a couple weeks, see how the market's doing. But I'm expecting it to roll over. We'll get one more pump on the markets into maybe the 14th, and then the third week will be options expiration. Who knows what's going to happen from 17 to 21, and then the last week of February will basically be Nvidia time. So I don't know what the last 2 weeks of February will give. But yeah, if you were long me, and if you have a lot of stocks that have done quite well in the past 2 years, especially tech stocks, I would be watching and seeing if you got to exit. Because if you took some profits last year, you got taxes to do. And then if you take some more this year, you'll have to do taxes for next year. So take into that consideration. Otherwise, you got to hedge with options or something if you don't want to sell your positions. That's about it. Okay, so we got that to think about. So we're going to worry about liquidity and all this stuff. I'm going to go over some article. So let's look at the Bessent stuff again. And I read a bit of this in the morning. So I'm going to read it again. Treasury faces its first tricky task under Scott Bessent. All right. No one used to care how the U.S. government finances expenses, but the master plan for funding could be the market's biggest event in the coming week. On Monday, today, so we already got some of that done, the Treasury Department will issue a routine forecast of the amount it expects to borrow through the end of June. It will offer a view of what its debt management strategy could look like under the Trump administration on Wednesday. We got to wait for Wednesday. All right, let's go down here. This announcement is particularly sensitive because it will be the first time since Scott Bessent took over as Treasury Secretary from Janet Yellen, the former Fed chair. He is a Wall Street pro who made his name working for the George Soros hedge fund, known as for breaking the Bank of England. The market loves a finance man managing Washington's coffers. It's possible Treasury could back away from what it said in November about auction sizes, given the large funding gap that exists over the second half of this decade, wrote Jay Berry, head of global rate strategy at JP Morgan. But we are unsure if it will be ready to change this guidance soon, so soon after Secretary Bessent's confirmation, given that he may want to take a renewed look at Treasury's debt management strategy. All right. So yeah, we have a bunch of things to think about for now. And let's look at the article that I read a little bit about, and I think this is a very good article. You can look in the description. You can find this. The Tech Equities Odyssey, Riding the Sirens Liquidity Song. And we went over a little bit of this, talking about liquidity and the TGA. So let's continue on from that. So if you watched this morning's presentation, so I'll start back from this point here, okay, and read this. The interplay between fiscal and monetary policy has reached a crucial juncture. The Treasury's liquidity injections, driven by its need to manage the TGA, have temporarily masked the tightening effects of QT, quantitative tightening. So TGA is a Treasury general account, propping up asset prices and delaying the full impact of monetary policy. But as the TGA drawdown ends and the Treasury pivots to replenishment, this dynamic will reverse, intensifying the liquidity drain from QT and creating new challenges for markets. Compounding these challenges is a structural decline in reserve balances. As reserves approach critical thresholds, historically around 8% of GDP, the risk of funding volatility rises. The echoes of 2019 repo crisis, when a sudden spike in funding rates forced the Federal Reserve to intervene to restore stability. Today's near depletion of the RRP further limits the system's ability to absorb shocks, leaving markets exposed to potential liquidity crunch. All right, so we can look at reverse repo right here. This is the reverse repo here. I'll give you the link in the chat, and you guys can double check me in the chat right here. In this area here, you see this green blob. So from January, March 2021, up and up and up, we went to 2023, and then we started draining this thing. So for the past 2 years, the S&P 500 has went up 20% each of those years, 2023, 2024, and we had a nice drainage of this whole thing. And now we're all the way back down here, okay? Only about 92, 97 billion dollars from trillions of dollars worth in injections. So we had plenty of money to inject the market with and pump it up for the last 2 years. We're almost done with that now. We're almost done with that. And we can look at here too. So we have RRP, which is what I looked at here. Now we have TGA coming down. So if Bessent is going to do what he does and try to reduce our issuance and deficits, doing it that way. And then the next thing that will happen is bank reserves will start decreasing too. So all these things together start decreasing, then you'll have to worry about the stock market. So that's what we're watching. All right. Okay, so you can look at these graphs. Go into the description. Look for this article. All right. Adding to this delicate balance is a significant foreign ownership of U.S. equities. Yeah, one of those early videos I played, they were talking about that. A substantial portion of U.S. stock market capitalization is held by international investors who have historically sought the relative safety and growth potential of U.S. assets. However, as global macroeconomic conditions evolve, these foreign owners could look to repatriate capital back to their home markets if higher returns or improved stability elsewhere arise. Such repatriation flows would exacerbate liquidity pressures in the U.S. market, creating additional headwinds for sectors already strained by tighter domestic monetary conditions. These patterns of fiscal dominance carries echoes of the unpleasant monetarist arithmetic described by economists like Sargent and Wallace. When fiscal deficits grow large enough, they force monetary policy to accommodate fiscal needs, limiting the central bank's ability to control inflation. The lessons of the 1970s remain relevant here, as persistent inflation eroded economic stability and exposed the risks of insufficient coordination between fiscal and monetary authorities. For tech and growth equities, the risks are clear. The sector's sensitivity to liquidity conditions make it particularly vulnerable to tightening cycle ahead. While fiscal dominance has temporarily insulated markets from the Fed's tightening campaign, this insulation is rapidly eroding. The confluence of QT, quantitative tightening, and TGA, Treasury General Account replenishment, and long-term debt issuance, the Treasury bond market, represents a powerful tightening force that could reshape the investment landscape in 2025. Okay? All right, guys, you can read the rest of this stuff here. I think that's quite important, what I've read. Okay? And we can go, and you can go look back at some of my previous videos. All right. So I can go back and look at some of that. So I can look at the Urban Landlord here, and you can look back at some of the previous videos I did, and I put them in the description so you guys can look at that. Man, it's taking a while to load. All right, let me just put this up here. Let me see. Yeah, that's not going to work. Let's see that. All right, finally loaded. Okay, so you can go back and look at the playlists. Okay, you can go look at the full chart here, charting the course with me, GetCrack. And you can look at here. This is the second one I did. Trump versus Powell, fiscal versus monetary, January 26th. And then I had another one, Fed Trek 3, the search for liquidity, January 9th. And you can go look at that in the description in this video and find it. Okay, so I can put up one link here. Guess I can do it one at a time for you guys. One link there for you. And the second link for you. All right. So you got two links. Go back. See what I said back then. All right. Now, let's continue on. Let's read these. So this was in relation to the topping candle you saw last week, or maybe 2 weeks ago. I forget. Yes, last week. All right. Tom Bowley says, when do I sell? Is the most easily asked question I've received over the years. There are multiple answers to this question based on certain variables. The first key variable is whether you're a day trader, short-term swing trader, or long-term buy and holder. I prefer swing trading, so my answer many times is when corroborating technical evidence tells me to sell. The easiest sell is after a failed attempt at a breakout or a major reversing candle on heavy volume. The first one is fairly easy to see. Let's use Palantir Technologies as an example from Friday. I don't know if Palantir is going up on Monday. Well, after the close, Palantir did go up. But here is what I do know is that it broke out to an intraday all-time high on Friday, then failed to hold that breakout on a closing basis. So you got that. Well, that didn't work out, right? So let's see what we got else here. So he's going off by like that one candle, and okay. Because if you look at the S&P 500, let's see what it is here. The S&P 500 filled its gap from severe drop on Monday morning, then printed a bearish engulfing candle on Friday. So that's what everyone saw because of the trade war. And yes, for the most part, you probably should sell. But if you have a very strong chart like Palantir, maybe you don't need to, especially if you know there isn't earnings coming around the corner. Okay. So, yes, this is not ideal. All right. Just looking at candlesticks, it can give you some hints. Sometimes it'll work out, sometimes it doesn't. Now, let's look at this second article. We're topping with a bearish action ahead. Listen, I'm generally a fairly optimistic guy. Yeah, Tom is usually optimistic. I tend to see the good in the stock market, while many others continue to focus on potential sell-offs ahead. I remain mostly bullish for a good reason, as the S&P 500 has risen 75% of all years since 1950. It just doesn't make sense to keep trying to bet against the stock market, especially when you consider the long-term 100-year monthly chart of the S&P 500. It's really hard to argue with this chart. It just goes up. Remaining long is nearly always the best answer. However, there are occasions when bearish signals begin to line up, and it's at those times that we need to take notice. The best recent example was as we headed into 2022. Currently, I'm not seeing as many bearish signs as I saw then, but I'm absolutely watching the bearish signs develop. The analogy that I would use is that major storm clouds are brewing on the horizon. Will we be able to skirt the storm, or are we about to get a direct hit? I'm beginning to think direct hit. Oh, well. Let me just talk about sentiment for a moment. One key takeaway is that it's a contrarian indicator. When others are bullish, we should turn bearish. When others are bearish, we should turn bullish. We can reach points of excessive bullishness, and we might be getting there now in the options world. Simply put, the number of equity calls traded are swamping the number of equity puts. We haven't reached the absolutely crazy period of extreme equity only put call readings that we saw in the latter part of 2021, just before the 2022 cyclical bear market drop of 28% on the S&P 500. However, those readings were insane and likely a once-in-a-lifetime, or at least a generation, bullish period. Current readings should not be ignored, as history tells us that current levels of market optimism have foreshadowed sell-offs in the past. I generally focus on the 5-day SMA and the 253-day SMA. So this is the simple moving average of the put-to-call ratio, and routinely communicate both to our earningsbeat.com members via our weekly market report. For purposes of this article, however, let's look at the 22-day SMA of the put-to-call ratio. Let's look. Let's see what we got here. Let's see what we got here. So we got this green line here, 22-day moving average of the put-to-call ratio. All right. Green, arrow. Okay, means buy. Red, sell. And then you got this area here where we had the post-COVID exuberance, right? You got like, oh my God, buy. No matter what, everything goes up. So that was like 2 years of goodness. 1 year of badness in 2022 when we had Jerome Powell pumping up the interest rates. And then we had another 2 years of goodness. So 2 years good, 1 year bad, 2 years good. Guess what? We're in 2025. What does that mean? Good or bad? Tell me that. So, according to this, we are back at the point where we have people quite bullish on the stock market because the put-to-call ratio is now at the lows. So a lot more people are buying calls than puts, right? Yes, John, I did buy the dip today. That was easy. We are in a range, and then we'll pump in February. We are in February. And then later in February, we'll crash. That's what I think. One last pump, and then a crash into March and April, then another pump in May. So most likely this year will be a sideways year. So you had two good years in the S&P 500, 20 to 30% back-to-back years. You have a sideways years, and then 2026 will be the bad time. That's one thing. But this year probably the thing that will do quite well is oil, natural gas, and commodities. So look at fertilizer, grains like soybeans, corn. Yeah, palladium, platinum, maybe gold and silver will follow. I don't know yet. And then from there, we'll go into 2026. That'll probably be the peak in real estate prices, late 2025, early 2026. And then something will happen, maybe in May of 2026. Perhaps Jerome Powell will get fired by Trump, and then the markets will start going down from there. So that's my prediction. Don't hold me to it, but let's go for that. Now, bracing for a drop, okay? So if we go look at these things, we see the red and green areas here. You see too much bullishness, too much bearishness, so we go contrarian. That's what the whole point of this thing is. So bracing for a drop. One of our favorite features of our service is our portfolios. Our flagship model portfolio is very aggressive and has outperformed the S&P 500 by a mile since its inception in November 19, 2018. Here are the model portfolio returns. Okay, so this is advertising. All right, for you to pay for this service. So a lot of people in this game try to beat the S&P 500. It's quite a difficult game. All right. Since we began the portfolio in 2018, we've never exited 3 weeks prior to the end of portfolio quarter. To give you some idea of how bearish I'm growing, I wrote to our members on Friday afternoon to let them know that we are exiting all stock positions in our portfolio a full 3 weeks ahead of schedule. So this dude, who's generally a tech bull, he really believes in the tech sector, has dumped everything last Friday. And I'll tell you this. What did I say maybe some streams ago? I said on February, we will go up, trap a bunch of people, and then crash into March. So I think some people have been taking notice. There is going to be a problem coming down. So this dude is generally one of the most bullish type of people out there, and he's already turning bearish. That tells you something. All right. So for you guys who don't have membership in Stock Charts, go to this link right here, and you can get some free scans like this. Okay, this is a free scan right here, and they'll give you predefined scans, and you can change the date to about up to a week ago, right? So let's do the close of Friday. So I can look it up everything here. So I can say which stocks made a new 52-week highs. And it's 40 less stocks than last. Okay, so it's gone down a bit. We have 527 stocks that made a new high that time. We also can look at bearish indicators, bullish indicators, all kinds of stuff. So we can look at candlesticks, right? A ton of stocks had a bearish engulfing pattern. So 578 stocks plus 509. So last Friday was a terrible day. So, but just by looking at this, I could tell like, oh man, Monday is probably going to be shit. All right. So yeah, you can get free scans. You don't need to pay money. You can go here and you can look. You're restricted by how many days you can look back. That's your restriction right there. You can't edit this. You cannot edit it. You can't just come in here and go like, oh, hey, look at this. I want to look at, hey, bearish engulfing, right? Let me edit it. Let me change this. So this is the script right here. Very simple. Bearish engulfing is true daily. So I can't just go back and go like 15 days before this or search. No, I can't do that. So if you're not paying member, yeah, you can't do that extra stuff. But for the most part, you know, you can do this pre-defined scans here. Go to that link. Here, go here. Okay. And you can do this yourself. So basically go stock charts, you can go predefined scans, search for that, and you can look. And if I search for the bearish engulfing patterns right here, looks like I do it this day. Now let me do the one from a week ago, okay? Or last Friday. Let me see last Friday. Make sure it's doing this. Okay, let's see. See if it works here. Maybe it can't. I don't know. 3. So 578. Okay, it says 578. Let me change the date to last market close. Okay. All right. So I guess it does work. It just gives this date of 3rd of February, so that's not right, but okay. So I guess this is from Friday. So I can look at that. And I can sort this by scooter ranking. All right. So scooter ranking, I could do this. Scooter ranking is basically you look for the best chart out of all this. So for one day, we had a bearish engulfing on Friday. And I can look for all the stocks that have done well before that day. ARC W, basically software. ARC F, fintech, another software. Hood, right? We talk about Hood. Yeah. So all these stocks have done quite well. One bad day. But hey, one bad day means buy the dip. And all these stocks will probably go up. So this is pretty good way of doing things. You can look for stocks that, you know, have done well through this method, and then you say, okay, you had a bad Friday, and then on a Monday like today, I want to buy the dip, right? I want to buy the dip. So all I got to do is look for the worst performing stock from Friday with the best chart overall for the last month, 2 months, whatever. I don't know how long scooters are. I think scooter is about maybe a quarter, at least a month, I'm sure they'll look over. So if this stock has been doing well for a month or a quarter, yeah, I can rank them like this. I'll ignore all the trash stocks down here, right? I'm not going to look at the bad stocks. You should already know they'll do bad. So I'm not looking at these, all right? So I'm looking at the top stock. So I'll use the scooter. So look back up here. You sort it by scooter, SCTR. So that's a stock charts technical ranking. Okay, so I can do that. So this is all free. So you don't need to pay money for this much of work. And you can look here and you can look at all the little like scans they'll pre-made for you, and then you can do this. So all free, and then you can look at which ETFs, which stocks I want to do. Yeah, look at this, like PEG, Dynamic Leisure and Entertainment. So probably Dave and Buster's or something like that, probably doing well too. SE, I've heard of that one before. I think that's Korean. Yeah, that's pretty famous stock. And let's see, RPG, Pure Growth, Delta Airlines. All right, gotcha. Yeah, so that's an example for you guys to do on your own. So you don't need me to do that. So you can find stocks on your own that does quite well. All right, let's do some more bearish articles here. Let's do this one. January 30th, 2025, McClellan. Rising new lows in the NASDAQ. See that? Rising new lows. If you get rising new lows, maybe a crash will come, huh? Let's see. There are certain relationships which work normally most of the time. And when they are working that way, it is not very remarkable. But when the normal relationship breaks down and starts acting differently, that gets our attention. This week's chart shows us that the numbers of NASDAQ stocks making 52-week new lows has been ramping up higher recently. That is not the normal thing to see while prices are continuing to push to higher highs. The normal relationship is that when prices are higher, new lows go down, and during sell-offs, these numbers spike higher. And since 2022, that relationship has been working that way for the most part. That is until late 2024. Ooh. Uh-oh. Uh-oh, uh-oh, uh-oh. We saw a similar ramp higher in NASDAQ new lows back in late 2021, just before the bear market of 2022. This does not mean that we will have to get the exact same outcome this time, but it does serve as a warning that things are not acting normally, at least for these data. When most people think of market breadth, they think of advanced decline statistics. We've talked about that in a couple of shows already. All right. Let's see. Okay. Let's see. But new highs and new lows is another way of looking at getting information from broad lists of stocks as opposed to just looking at the capitalization weighted price indices. For 80 data, I do not give much weighting to the Nasdaq's 80 line because it has such a persistent negative bias. The Nasdaq has looser listing standards than the New York Stock Exchange, and so stocks which are going to IPO then go broke are more likely to do that on the Nasdaq than on the NYSE. And this skews the 80 stats over time. Some technical analysts like to look at new highs minus new lows, but I find that not to be helpful. I would much rather look at just new highs or just new lows so that the result does not get skewed by price surges up or down. A stock making a new 52-week price low is a stock that is in a downtrend. So if you want to know about how the bottom of the roster is doing, then comparing that number to the 52-week new high number will contaminate the message. That is why the chart above shows just new low data. One other interesting point about new high, new low data. Many years ago, the data were tabulated differently. Before computers, clerks used to keep track of the price history for each stock using paper ledgers. And they had a different ledger for each stock and for each calendar year. So the stats that were reported for new high and new low were really about whether a stock was making a new high or new low for the calendar year. This methodology would understandably get into trouble in early January when there was not much history to compare to. Still, the statisticians would include the prior year's history for a while. Then, around April each year, they would switch to using just the new year's ledgers. This meant that the look-back period for evaluating whether a stock was making a new high or new low ranged from 4 months to 16 months. Oh, this is terrible. Terrible. That all changed in 1980 when computers allowed the statisticians to switch to a more uniform 52-week rolling look-back period, which is the method used to this day. There are data for new high, new low before 1980, but they are not comparable to the data from post-1980 methodology. So, anyhow, as you can see, data might not be the same data before 1980 as post 1980, and maybe not even before the 1920s and post 1920s. So yeah, if you're comparing a bunch of data, you better make sure where it comes from. If tinkering around the new high, new low data for the NASDAQ and NYSE is something you are interested in doing yourself, we make data file available for purchase. There you go. That's the plug. So they got some data for you that they cleaned up, and you're gonna have to pay money for it. Plug. Nice plug there. Okay, good. That covers a lot of what I wanted to do. Today, you guys have a good idea of all the bearish thesis that you got to think about. And I have some more videos to play. Let's see what is going to be more important here. I'm going to play the January effect one. I've talked about the January barometer before, so maybe this will be a refresher for you guys.
Factor. and implications for 2025. Welcome to our FSC monthly vlog with your host, Ron William, FSC Development Director. This time we'll be making a seasonal timestamp focusing on the month of January as we come to a close and discuss the Janus factor, the symbology of it, ultimately the seasonality effect of what is deemed the January effect, and the context of the trend that is current. We'll then shift into seasonality setups because, of course, context is key. A look at bull and bear examples, the potential bear rhyme of 2008 versus 2025, which is my risk case scenario for this year ahead, and then also close on this composite seasonality measure, the trifecta mix of three different January measures, which we should keep in mind. And then to close, final insights in terms of the election inauguration playbook, a week on after Trump 2.0 has come into office, and the headline news that follows and market impact that is upon us right now. And then, of course, timing in terms of the FSC model and external cycles such as the decennial and the 41th-month pattern. Happy New Year. All hail Janus. The calendar month of January originates from ancient Roman culture, named after Janus, a dual-faced god that could see both the future and the past. And it's within this archetypal symbology which ultimately influences collective psychology over the ages, as well as even financial market analysis in this seasonality moment of the year. We look forward based upon how we start that year. As the year starts, so the year likely follows. Now, this became part of what is now known as the January barometer effect, inferring, as I just mentioned, as the year starts, is how the year will likely go. It was popularized in the Stock Traders Almanac during the 1970s by seasonality expert Yale Hirsch, and continued by his son Jeffrey, and recently studied in an academic paper. In behavioral terms, the January barometer measures investor sentiment at the turn of the year, which is often a pivotal time. So just keep in mind the symbology, but then also the practical and behavioral barometer measure that we're looking at, as well as the statistical evidence, which shows that more often than not, there's a linear extrapolation for better or for worse in terms of the year ahead, whether we start positive, end positive, or negative. And here we can see data showing how this fares in combination with election years, bull and bear examples on the left. The trend is your friend, except context. That's the follow-up that we need to dive deeper into as part of the trend is your friend philosophy. The January barometer, as we just spotlighted, is a linear trend extrapolation, essentially. As the year starts, so the year will likely continue. But at the inflection points, we have to keep in mind where the cycle changes and ultimately the trend itself may bend. Indeed, the ancient Roman god of Janus had the qualities of a good investor with a supernatural advantage to judge the right balance and context of historical precedent when considering future performance. And it's that balanced, experienced judgment which is so key. All too often, mortal investors such as ourselves develop hindsight bias after strong trends, hypnotized by a rearview mirror of past returns, and fail to identify and adapt to a potentially changing market landscape at key inflection points. And you can see here, the chart below is one that I created some time ago and update each year in order to provide that historical context of when the trend is our friend and the January barometer does a trend extrapolation, same for the start and likely for the performance ahead, and which are those times where things do change and or bend in the opposite direction due to cycle inflection points. As part of that deeper dive into context, beware of the potent cocktail where we see this KO face-off between crowd wisdom and asymmetric risk. What do we mean by that? A potential inflection point ahead in the market as we continue at these record extremes. Case in point this year, 2-year stock market bull rally, back-to-back 20-month 20% performance, I should say, for the S&P 500, a doubling effect on the NASDAQ, amplified by record investor exuberance, as I've mentioned before, in extreme momentum and positioning measures. Meanwhile, in terms of expectations, Wall Street's smartest and brightest, based on investment banking consensus view, is predicting that the S&P 500, yes, you guessed it, will go up some more, same as before, to the tune of 10% in the year of 2025. And there is only one outlier, one lone wolf bear that is looking for a risk scenario of a minus 30%. And now this does include myself, but I'm not in these figures here. This is official reporting from Wall Street consensus. And ultimately, this shows the likely bias built into the market right now after a very strong trend. Now, what emphasizes this point is the chart on the right, on the top side, where basically we can see 2024 is the sweet spot, middle of the bell curve in terms of probabilistic returns that we've seen. But the outliers are, and the asymmetric risk is to the left side in 2022, where we had a minus 20% correction during the shock in inflation and rates, and then the big bear debacles during 2008 and echoes of that in history of minus 40%. So keep that in mind in terms of the potent cocktail of crowd wisdom and asymmetric risk. What happens at key inflection points, and when typically the crowd and the trend can be proven wrong. And in this case, bottom chart, it shows you the end result. If you look at the blue bars, this is the difference between consensus estimates and actual returns. And you can see here, it's fairly thin across the board, but the big negative surprises are when the cycle turns from bull to bear, consensus gets caught off guard. That happened in 2022, 2008, and Y2K. So more often than not, the trend is everyone's friend. But at key turning points when the cycle turns, most get it wrong, and that's when we must stay alert and scenario plan. And ultimately, that's when seasonality analysis can give us an indication of that. Now, looking at the seasonality setups that we are in and likely to follow this year, keep in mind my quadrant scenario grid, which allows us to plan for different potential outcomes ahead of time. To be prepared is to be forewarned. Look at the pattern over different seasons. You can see here, positive year, top right-hand corner is a positive trend expectation. The opposite is true in the bottom left-hand corner. We typically get the positive signal for the positive year more often than not, because the trend is typically up about 2/3 of the time. But keep in mind the negative surprises. In the bottom right-hand corner was 2008 as a case in point. We had a positive start to the month, to the year of 2008, but a negative end for that example, or a negative start to the year and up for the year, which according to my work is less likely because we are closer to the top than the bottom. And of course, we have the asymmetric risk in between. But that's something to keep in mind and maybe to pencil in your notebooks as a way of preparing for multiple scenarios, particularly when they are surprise factors. Now, one of the case examples of a surprise factor was 2008, which was down 30%. That did give an example of what were to follow. And the same thing happened in 2022. So either.
All right. Let me play this other video because we're going to skip ahead, go to the decennial pattern.
Hello, and welcome to Navigating. I find the interesting fact about all of this that not only did it find the peaks and the valleys very accurately, but also define the trend. Not perfect, but certainly very easy to do, based on history, no interpretation, no analysis, no Fibonacci numbers, none of that stuff, just the raw data. Isn't it interesting that we generate this chart right over here without this data and then show this data independent of all of this right here? I take that to be a strong testimonial, excuse me, in favor of seasonality, something that you'd want to take care of and look at very clearly. In the next session that we do, I will show the prediction for 2025, and then at the end of 2025, provided we're still here and viable, we'll take a look at it and see how did they compare. I think it's very fascinating. But I have something more interesting for you. Many traders have talked about the decennial pattern, the 10-year cycle, the presidential cycle, what happens to the market after a new president takes office, what happens to the market in January, February, March, and so forth. And many of the traders have talked about something called the January barometer. Be careful what you believe. Be careful what you tell yourself, because you may start believing it. The January barometer is not a barometer because it does not contain the necessary elements to be a barometer. It simply says, as January goes, so does the market. That is not specific enough for me. I want specifics. So what I did was very simple. I used the power of artificial intelligence. The question is very simple. It was based on the idea that January is important and the years numbered 5 are important. In other words, 1975, 1985, 1995. Most traders believe that years ending in 5 have been bullish years. That's only part of the story. I want to be more specific. So when I do my work, I do setup, trigger, follow through. The setup in this case would be the assumption that January is important and the assumption that the years numbered 5 are important. So how do you put these two together? So I went to chatbot, GPT, and I said, have years ending in the number 5 that close above the January high been bullish years? Very simple question, something that's certainly within the capability of artificial intelligence. It's even within the capability of actual intelligence, of which there is very little these days. However, computer says, yes, years ending in 5 that close above the January high have generally been considered bullish. So what does that mean? Behaviorally, it means at the end of January, take a look at the high and the low. And if we close above the January high at any point thereafter, that would predict a bullish outcome for the year. As far as I'm concerned, it needs more than that, but let's see what happens. So I asked the computer, what has been the percentage accuracy of that? Of what? What has been the percentage accuracy of the market remaining in a bullish mode for the rest of the year if it closes above the January high? Now we have a setup and we have a trigger. The setup is the January ending in 5, and years ending 5, and the trigger is closing above the January high. Computer says the predicted accuracy of that pattern has varied, but has been around 70 to 80%. Well, if you ask any trader who's been around for a while, if they can achieve 70 to 80% accuracy, they would be thrilled to do that. So here we have a basic pattern that's been correct a high percentage of the time. How do we use it? Is it a cycle? I believe it's a cycle within the broad definition of a cycle that I use. In other words, it's a pattern. So, of course, observing proper decorum, I thanked Anna because I don't want her to get mad at me. And then we did some research. Let me show you what I'm talking about. So here is the chart. Year ending in 5, 2005. These bars are monthly high, low, open, close for the entire month. So this would be the January open, high, low, close, February, March, April, May, June, etc. You get the picture. It's not rocket science. So I'm looking for a closing above the January high. This is the January high, the red line, And at no time for the rest of the year did we close above the January high. We penetrated it briefly, but we did not close above it. So you say, well, we closed below it. Is that a sell? The answer is no, because this is a buy pattern only. This does not work for sell. Therefore, in 2005, based on this concept, setup and trigger, there was no trade. No problem. Let's go to another year, ending in 5. And remember, this is specific only to years ending in 5. This does not have anything to do with economics, with politics, with geopolitics, or anything like that. Earnings reports or anything. It's just a simple pattern which we have defined operationally as years ending in 5, the penetration of the January high, and get this, the January high must have been penetrated on a closing basis 2 consecutive times. Let's see what that means. Let's take a look at this chart. 2015, number 1, does it meet the requirement for a year ending in 5? The answer is yes. Number 2, did it end any month thereafter with 2 consecutive closes above the January high? So here is the first close above the January high, but there was no second close above the January high. Here's another one here, but no close above the January high for a second time. Therefore, this year did not trigger that signal. I want to make sure that everyone understands this, so we're going to do this again in another year, numbered 5. This is the year number 1995. So let's take a look, because here is your classic example, your paradigm, your model for this particular pattern. And the good thing about this is, hopefully, we will still all be here at the end of 2025 to see how it turned out. In fact, you will notice a further pattern in the data, pattern number 1. It usually triggers within the first 6 months of the year. Pattern number 2, once it triggers, the year usually continues higher and ends toward the high of the year. So this is the model, the paradigm for that year, 1995. Now you may be tempted to ask the question, what was happening in 1995? What was the political outlook? What was the economic outlook? What was the geopolitical outlook? I don't care. All I care about is the pattern. So let's talk about the pattern. January ends, high and low. Here's the January high, right over here. And then February and March, 2 consecutive months in which we closed above the January high. A beautiful example of the trigger. What would most traders or investors be thinking? They would be thinking retrograde. They would be thinking, well, it's too high right now. What does that mean? How do they know it's too high? What does too high mean? There is no such thing as far as I'm concerned. They would be thinking, I knew this was going to happen. I should have bought it over here. I should have bought it over here. There is no should have as far as I'm concerned. The fact of the matter is, this is a trigger. And the trigger says, buy right away. Use what I call a GMI order. Jokingly, get me in. Or an LMI order, which means let me in. But no, most people will say, I'm going to wait for a pullback. Sometimes the wish for that pullback will come true. Most of the time it won't. And you can see what happened. The buy trigger was here. This was the setup right over here. And you followed through to the end of the year and ended the year almost on the high of the year. Clearly, the specific pattern we talked about. Year ending in 5, 2 consecutive closes above the January high, follows through to the end of the year. There's only one thing that's missing now. Actually, 2 things. Number 1, the stop loss. Number 2, the profit target. The profit target is easily figured out, and I will show that at the next session. Today, I just want to have enough time to get through the basic pattern because we are going to look at all the years numbered 5 all the way back to 1900. Boy, oh boy, that's going to be fun, isn't it? Let's take a look at the next one. 1985. So what happened in 1985? Very simple. We established the January high right over here. And then, after playing around with us for a few months, we got our first close above the January high, second close above the January high, and we were off to the races, had a little bit of a pullback, and then ended the year on the other pattern, which is the high of the year. So we've seen that established a number of times. Now, statistically, it would be good if we had 100 years of data, but 100 instances of the years numbered 5, but we don't. We're using all the data we have, and so we have to do the best we can and watch for this pattern. Let's go to the next year. This was 1985. So here's 1975. Now you're going to say, of course, it's a decennial pattern. Whatever you want to call that pattern, it is what it is. It's either going to work or it's not going to work. It's either going to trigger or it's not going to trigger. It's a cyclical pattern. It's a cyclical seasonal pattern because we're using the months of the year in order to establish our entry or our exit. So let's take a look. 1975. And by the way, why am I using the Dow Jones? I'm using the Dow Jones because it's the longest continuous data set that we have. Some of the others don't go back as far. So we can't use the S&P if we want to get a full picture of as much history as we can. And remember, as cyclical traders, we try to get as much data as we can, not as little data as we can, because if we get more data, we have more statistical reliability. And admittedly, certainly this particular pattern lacks statistical reliability as much as it should because the data set is limited, but we do the best we can. So here we go, 1975. Bingo and bingo. You're off to the races. And once you see the pattern, you're buying at the market. Now, certainly we didn't end the year at the high, but we recovered a little bit from the previous sell-off. We certainly did make money on this trade because this is where the entry was right over here. So that was 1975. And by the way, if any of you have questions about this pattern, you can certainly research it yourself. The data is out there, but I'm happy to take your questions by email. Let's go to 1965. So what happens in 65? We establish the high of the month right over here. And we have our 2 consecutive closes above the high right over here. For those of you who are waiting for pullback, your wish came true all the way down here. So what would be the stop loss here? Closing below the January low would be the risk. You can see that did not happen. We came close, but we did not close below it. We penetrated it, but did not close below it. And that's very important. Excuse me. So then what happens? We go on through the rest of the year. We close the year very strong. In fact, we end the year on the high after a little bit of heart failure here. But again, it's all about being systematic. So when you got into this trade, you knew what the risk would be. If you didn't like that, you could certainly have done this with a long-dated option and so forth. But I'm not going to talk specifics about that. I'm just going to show you the pattern and let you be the judge. That was 1965. So let's go back in time to 1955. So this is 1955. There's your January high right over here. And here's your 2 consecutive closes above the January high. And here's your follow through to the end of the year. Now, maybe I'm just hallucinating, but many of these charts are starting to look the same. Isn't it interesting how similar the years are, even though the geopolitics have been significantly different? Remember that since the early 1900s, we've had the Great Depression, oil run on the banks, we've had OPEC, we've had Middle East war, we've had Democrats for presidents, Republicans presidents for presidents, morons for presidents, and none of these seem to have made any difference in terms of this particular pattern. It's possible that there's a further correlation going on. We can ask AI to find it for us, but right now, I'm happy with what we did discover, and we certainly intending on using it. So let's go to 1955, and we've seen the pattern there. Let's go to 1945. The world coming out of the war, and people would say, well, the war was a significant event, and therefore this pattern won't be repeated. So let's take a look. Here it is, 1945. There's the January high. There's the January low right over here. There's one close above the January high, but it did not happen until here. You had 2 consecutive closes above the January high. You wish for a pullback came through, and here we go to the end of the year. And that year-end strong pattern is very significant and keeps repeating. Let's go to the next one. 1935. People would say, 1935. Whoa, there's a lot of bad stuff going on in the world, a lot of geopolitics. Watch out what happens. So here it is. Close number 1, close number 2. So there's the trigger and follow through to the upside to the end of the year. 30% gain. Let's go back to the next year, to the previous year, 1925. Here we go. So what happened in 25? In 25, we had our 2 consecutive monthly closes above the January high right over here. And bingo, there's your buy trigger and follow through to the end of the year very strongly. So let's review what we see. Years numbered ending in 5. Number 2, 2 consecutive monthly closes above the January high. Number 3, it's a buy pattern. Number 4, your risk is a close below the January low. So please let me point this out to you, very important. We did close below the January low, but the trigger had not happened yet. So therefore, we couldn't be stopped out of a position because we had no position until here. Let's go to the previous one, 1915. Here's 1915. And what do we see? Well, whopping gain of 38% through the end of the year. I put this in incorrectly. This should end right over here. So there's our 2 consecutive closes above the January high. And I want to reiterate something super important. Remember, most traders and most investors are looking to get a bargain. They're not looking to buy on strength, even though we know statistically and behaviorally, the fact is buying on strength is much higher in accuracy than buying on a pullback. When you buy on strength, you're getting on a train that's moving in the right direction. When you're buying on weakness, you're getting in a train that's pulling back into the station. You don't want to buy into that because you're generally catching a falling knife. So buying on strength is a good strategy. So that's 1915. I'm not sure if I have 1905. Let's take a look. Just a moment, please. There is 1905. And here's your 2 consecutive closes above the January high. Here's the pullback you've been waiting for. Although remember, you're buying on strength, so you would be technically long right over here. Your stop would be closing a month below this low right over here. And there's that pattern again, follow through to the end of the year in strength. So there you have it. Years ending in 5, setup, trigger, 2 consecutive monthly closes above the January high, follow through to the end of the year. Stop loss is a closing below the January low. That's all there is to it. If there's any questions, I'm glad to answer them. Let me show you one more thing. So,
all right, so you went through everything to 1905, and you see the whole trend, right? Let's see what we can do this year. If we can get 2 good months this year, that's the time to buy. But I'm thinking we're going to get a good February and a bad March, right? That's what's going to happen. And then we got to wait again and see if we get back to the old January high that was set already in January. So we kind of got to the last, for the S&P anyway, got to the last December high. Pretty much. We got a slightly new high above December. So we got to wait for that. Now, last video I'll play is Samantha talks about software stocks. And we're going to have to go back to some software stocks. And we're going to have some software earnings, I believe, coming up. So let's hear something.
The 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
So yesterday we could see the rotation into some of these IGV plays like this. You can kind of come over here, ESTC. Look at this, gorgeous It's trying again. That was earnings, and then it came back down. Mosh pit of moving average support. It's trying to get going again. Hubs yesterday was up. It continued higher today. Look at that gorgeous scoop pattern. So this sector of SaaS reacceleration is in view. You can see money's not leaving the market where everything's red. We had pockets of intense selling in semis and NVIDIA, but they're still buying up the software AI plays and probably healthcare AI plays. And we'll find a recovery most likely in the Dells of the world, the IBMs, the ARM, but right now they have to digest, no question about it. The stuff that I see moving right now is in this IGV space. So if you're shopping for longs, plant yourself there. I mentioned the themes. I liked this weekend even before the bloodletting in semis. I still like big picture, higher Qs, semis, NVIDIA. Yes, I will admit, I don't think they're done. But for right now, the Apple move higher, my goodness, it's made it all the way back up. Didn't even come down to the 200-day. I felt a little ripped off, but doesn't matter. It is absolutely working as it relates to this weekend going, this is going to be a beneficiary, and it's huge. So we're right up to the 10-week. And then, of course, BABA, I think, is digesting really well above some key levels, but it's got to hold the key levels to keep going. And this IGV space of SaaS reacceleration, there's just a bunch in here, right? Look at the green on the screen. I mean, it's a big sector too. Twilio's in it. That was their investor day. This is above the 400 week. That's so bullish. Look at this run right up into the 146, 147 area. Amazing. Apple bullish. You got your GitLab in there. Remember GitLab? Look at this thing recover. So this was a swing long idea when it did a great job, and then earnings, it came right back down, and it did stay, but it took several weeks. Did not break below, get back below that trend line, and now look at it. So I still see this, I'll say an IPO too, but those two sectors of fresh money coming in. GitLab is now back in play. I like this one. Look at crowd. All time. Is it all time? Nope, not quite. It's making it up to its level before the blue screen of death, and it lost 50% of its market cap. So it has literally, since the August 5th low, and it was helped by the yen carry trade, but it was mostly the 50% drop in its stock because of the software glitch. Anyway, look at this, making it all the way back up to all-time highs. So we've got software here and SaaS plays that are ripping. I'm sure if I look, I'm going to find, look at Datadog, came right back, pulled back. Now it's getting supported, 138. All right, so Kevin is long GitLab. I think that's June 70 calls. Such a good play. I like that a lot. Congratulations. Yep, I like that a lot. Now, it really has to stay up here, but look at this beautiful scoop. Pullback was aggressive. There's no question about it. That was more than I would have liked, but it did consolidate. Beautiful. And now it's come right back up. I like this. Can you keep it above 65? It has earnings in March, plenty of time. It is going to be choppy. It is going to take time. Look at this 200. It's going nowhere fast. But if you but you're obviously patient, I think this can move right back up into this kind of 78 area, and then we'll see what happens. A clean monthly would be, it just needs to get above. Look at this tap. This was productive, and then it got a huge rejection here. Evening star reversal, came back in. It has a good job, then it got rejected. This has to get above 71. It's going to take a little bit more time. You really ideally want to get up above this 71, hold. This is your channel, your next channel. And then once you get above 78.53, this will become very supportive. Apple, right up into that trend line. It's a sloppy little trend line, but humor me, is probably where it digests today. It's coming right into that 237. That would be price target. And then I think it's done. We should have some softening tomorrow. Should. But so far, this thing is absolutely bid up as a huge beneficiary of AI cheaper and faster. Your book and your phone has just become, you've just become a developer. That's what the bid is, I believe. And then anything SaaS reacceleration, they're really moving into that space right now, again, after a digestion period. Remember Docu? We couldn't even find good options. I remember we talked about this and Hans and I were looking at options going, they're awful. This was back in September. Remember that? September, October? Hans was like, the June's okay. It was, now look at it. It had this ginormous explosive move, and now it's come back to the 10-week, and now it's getting going again. So they're choppy. The options aren't great. Docu's probably better now for sure, but my point is it was left, it was ignored. It was left for dead because it had stayed here for so many years. This is the SAS rate acceleration I'm referring to. February, $100 calls. This is the magnet they're jumping on, up 100% just today. So really, these are moving intraday too. There's your support. Keep it above 92. Look at GitLab go. Oh my God. All right, so we're being chased, but there's that 71. You got to get above 71, and you know that's going to be challenging. Look at these from the morning. Look at this. This is crazy. So this morning you have IPO plays pushing. This is called the Wisdom Tree Cloud ETF. You can kind of see this migration. Bug is the hack ETF. So Sky and Cloud and WCLD are all internet or SaaS or mid-cap tech, whatever you want to call it. I like the IGV bucket in here. Remember this ESTC? Gorgeous. Pushing back up. Docu already talked about that. That is gorgeous with $100 calls for February coming in of size. Hubs was already pushing yesterday. Look at that scoop pattern. I mean, these are gorgeous. Really strong rotation into CRM. Now got defended, got right back up. Market is not tired. Money is not leaving the market is what I'm trying to say. Little bounces for semis and then big moves in the mid-cap tech plays. Pretty much throw a stick at it. They're all trying to be really relevant here. GitLab looks good. Keep it above 68, could be a little choppy, and definitely you want this scoop to follow through. Oh, I haven't even looked at net. Cloudflare, 1, 2, 3, 4 months of green candles, very firmly in breakout mode, but very extended. Huge reversal. Evening star reversal is very bearish trend reversal back in 2021. Dead money, really. Dead money. A little lower, a little higher level of dead money. Didn't actually get going until Fed pause and Yellen Yahtzee, got rejected, came back in. Productive. That's going to be tough though to get above. This is strong resistance and it's trying to get above. So in other words, this is your auction, right, of buyers and sellers, absolutely destroyed, extended and then dumped. So if they held, they rejected, perfect. I mean, absolutely gorgeous. Another evening star reversal, dead money, fake breakout, nice scoop. Can it really get back above? It's already extended. Gorgeous breakout above 200. Pullback was shallow. It has stayed green despite all the semi-disturbance. Huge bullish engulfing yesterday with a huge bullish expansion candle right into a wall of monthly resistance. 132.45. It's above it, but it's got to close above it and keep going. Measured move is 169 roughly from that 86. Remember, I just did that on a monthly, that trend line with a scoop, getting above the Keltner and Bollinger Band. Look at that. Pops up, comes right back in. It's kind of shy. Anyway, the trend line breakout of confirmation is about 86, double that roughly. And then I'm looking for the next high. It's 169.80 on a weekly. So it's an if then. If it holds, first of all, on a trend time frame, you can use swing. If it can hold 116, and it has earnings next week, so good luck with that. If it can hold 116, great. 107, 116 would be broken. This is very extended. The mean is literally down here about 97, and it's literally just tagged 135, so it's very extended. But big picture, we could do some shake and bake, maybe around earnings. It gets defended, and then it moves higher. The price target from this breakout is double 86, but the next logical place is this 170. So you have a tiger by the tail, which means it's absolutely in play, but it has earnings on the 6th. That's your risk. And it's already running up into earnings. Now has also been a great, remember this was a double that has not hit yet, but remember this breakout, gorgeous. And I said, if this can stay above this kind of 750, what's my price target? 1,500. And it's still working that way. Can't even see it. It's all the way up here in time. This is a trend. This is just continuation of this trend. So now is still in play. 1150 area becomes 1500 area in time. So far, it's still working. Anything above that 750. Now, Net, Docu, lots and lots of software plays are pushing higher. This is definitely the Momo space. Twilio from Investor Day, Apple from DeepSeek, which is not even calming down. Like, it is not even respecting prior highs. Like, good luck with that. It is very, very much potentially squeezing shorts too. So it did not make it down to the 217. It did not make it down to the 50-week, but it did get DeepSeek momentum, and that has followed through, and that's helping the software space. IGV IPO is less exciting, but IGV is definitely exciting. And it's funny because I saw this on the weekend. I'm like, I like this. I still like that. Believe it or not, I'm still bullish on the market. We got money rotating, which is the most important thing. As semis digest, they've moved clearly into software from hardware, and we can see that in spades.
All right, so software from hardware. Okay, there we go. And let me go over some things before we close down here. Let me go over some things. So, Super Micro, somehow it's up 8, 9. It was up 11% after hours. So, I'm probably gonna dump that. I'm in SMCX. Okay, so I'm using the leveraged version of that. So yeah. It was as high as 20-something% after hours. So let's see what happens. I'll dump that. So letting you know if I don't show up tomorrow. Yeah, on the morning, if I see good gains there, I'm done with that trade. And let's see what else. What else I got to do. Show you the earnings before I wrap it up. Let's look at what the earnings are. So we got Palantir, right? We know that was done 20-something% after hours. NXPI has a little pump up today after hours. So tomorrow morning, PayPal, Spotify, Pfizer. So PYPL for PayPal, Spot for Spotify, PFE for Pfizer. You got Merck too. So if you're doing biotech, MRK. Oh, yeah, Ferrari too. Race, RACE. And then afternoon, after the market closes, you have AMD, Google, GOOGL, Snapchat, SNAP, and Chipotle, CMG. Okay, for tomorrow. And then later on this week, you got Uber, Disney, Novo Nordisk, ARM, Qualcomm. And then later on, Eli Lilly, Amazon. Okay, so Cloudflare, Net, as Samantha was talking about, Affirm, AFRM, Fortinet, FTNT, Microchip, MCHP. So, and O'Reilly too, O'Reilly Auto Parts, very good stock. So we'll talk about those things as we go along. But tomorrow, again, big time earnings for Alphabet, Google, AMD, and Snapchat. That's big tech for tomorrow after the close. All right, I'll see you guys later.
Feel like I should, feel like I should, feel like I should, feel like I should go. Go. Feel like I should go. Feel like I should, feel like I should, feel like I should, feel like I should go. Feel like I should go. Feel like I should, feel like I should, feel like I should, feel like I should. Feel like I should go.